In this presentation, we will continue on our comprehensive partnership problem, recording the adjusting entry related to depreciation. For more accounting information and accounting courses, visit our website at accountinginstruction.info. So it will be on 1/31, the end of the time period, the end of the month. We're going to record the depreciation on 5-year equipment. So before we do anything else, we're just going to go through our knowledge that it is related to depreciation. It is an adjusting entry, and see if we can decide which accounts will be affected and which ones will be debited and credited without knowing much else, and then we'll talk about why. So we know that adjusting entries will not involve cash. They'll involve one balance sheet account, more specifically a liability or asset account other than cash. So that's going to be something up here related to depreciation. If we look through them, we say, I see one called accumulated depreciation. That looks like a contender, so we're going to say that's probably one of them. I'm going to put a little yellow dot saying that that's one I think is going to be involved. Then on the income statement below the blue line in the dark blue, we've got another account that will be involved related to depreciation. How about depreciation expense? Looks like a contender. That's going to be the one. So those are the two accounts affected. We can see that depreciation expense has a debit balance. They only go up in the debit direction. Therefore, we're going to do the same thing to it, another debit. So we know we're going to debit depreciation expense, so we'll copy that. Right-click and copy. Scroll back up, we're going to put that on top in C11. Right-click and paste 1, 2, 3. We know that if we're going to debit that one and there's only two accounts affected, the other one must be a credit to this one, because that's the other one that we're using here. So we're going to copy that, right-click and copy. Put that on the bottom in C12. Right-click and paste 1, 2, 3. I'm going to indent that, which is probably already done for you. Go into the Home tab, Alignment, Increase Indenting. So we can know all that without knowing much else about depreciation. So let's talk about what is depreciation and why are we doing this. So note that depreciation is similar to what we did to supplies, in that supplies we bought at $16,000 and then we determined how much was consumed. We brought it down to the amount that's left, and then we expensed the amount that was consumed at the time we consumed it. The same is happening for equipment. We purchased the equipment, and let's just assume it's one piece. We purchased 2 times. But we're going to simplify this, and we'll talk about methods of depreciation and how to get to the number later. So we could have multiple pieces, but just assume that this is one piece of equipment we purchased. We know that we're going to put it on the books as an asset because we didn't use it. We haven't consumed it to help us generate revenue. Throughout the time period, we will consume it. We'll use it, which will decrease its value. And as we do that, we're going to reduce the equipment, and then we would record equipment expense related to what we've consumed. The difference here is that, like supplies, we know exactly what we consume because it went down, we can count it. And we can't account the equipment. The equipment, if we had one forklift, we still have one forklift. We can't really know exactly that it went down in value, and therefore not really know exactly the value that it went down by. So to tell our reader that, we're going to make up this other account. We're going to break out the T account into like a 7 and an R, like 2 accounts with a debit side and a credit side. So this is the debit side, and this is really the credit side. Our first contra account related to depreciation or related to anything is our first contra account, meaning it's an account that has an opposite balance to the normal account balances. So this one's a contra asset account. Assets normally having debit balances, this having a credit balance. So this is going to record the decrease. So instead of recording the credit up here, we're going to say record it here, and that'll tell our reader multiple things. It'll say, hey, reader, we bought the equipment for $60,000. It has gone down in value. It's just an estimate. Here's what we estimated that it went down in value by. And then the difference between those two is what we believe the book value, the current asset value or worth currently is. And then the other side we're going to call, instead of equipment expense, we'll call depreciation expense, which is kind of like the same thing. Depreciation must be on a depreciable asset, which would be like a fixed asset, property, plant, or equipment. And this is going to be what we believe, the estimate of what we believe we consumed of these fixed assets that don't really go down physical value in units, but obviously do go down in value. We are allocating the cost to the period we think it was consumed in order to help generate revenue in accordance with the matching principle. Okay, so now we just need to know what that number should be. We're not going to get into depreciation methods. There's a bunch of different depreciation methods. We're just going to give a simple calculation. To do this, we can have a whole course on different ways to depreciate. So the journal entry, though, whatever method we use, will always be the same. So what we're going to say is it says there's 5-year property. So we'll do a type of straight line depreciation. We're going to assume we purchased this all on January 1st, and then we have 1 month of depreciation for all the equipment. Again, in practice, we may use a different method, might be more complex. We may have different methods between tax and books, and we may have multiple pieces of equipment that we have to depreciate using different years and methods and whatnot. And so that takes a whole thought process in and of itself. But from a simplified method, the starting point method, this is one piece of equipment we're assuming, purchased as of the beginning of the month. We're going to depreciate it as of the beginning of the month of January, and it's 5-year property. So all we're going to do, we'll do it with the calculator first, is take the 60,000 divided by 12. I usually think of years first, and that would be, wait a sec, 60,000 divided by 5 years, and that would be 12,000. So 60,000 divided by 5 years, that would be how much we would depreciate for an entire year. And then only 1 month of the year has passed, so I'm going to divide that by 12. And that'll give us 1,000 for this month's worth of depreciation. So let's do that again. We're going to say here in cell D11, this equals, we're going to put the entire 60,000 divided by 5 years, and then divide it again by 12, the number of months in a year, to give us 1,000. The other side will be the same for the credit, and there we have it. Let's post this out and see if it does what we think it should do. What do we think it should do? It should increase the accumulated depreciation, but in a contra asset way in the credit direction, and that will bring the equipment minus the accumulated depreciation down. It'll bring net income down by increasing the expense of depreciation expense. Okay, so here's depreciation expense on the journal entry. Here it is on the trial balance. We're going to be in the middle column in I-25. Where we will say equals, scroll up just a bit, point to that 11,000. Once we hit enter, it'll bring this up. That was 1,000, I believe. It's going to bring this up by 1,000, the expense, put us out of balance by 1,000, bring net income down by 1,000. So there we have it. This goes up, out of balance. This goes down by 1,000. Then the other side, accumulated depreciation, is here. So we're going to be in the middle column. We're going to say equals, point to that 1,000 credit, bringing the 0 up by 1,000 to 1,000. So note what this tells our reader now. We say, okay, we have equipment. The equipment was purchased for 60,000. We know the equipment went down, but it's just an estimate, so we're not going to take it out of the 60,000 here. We're going to give you more information by breaking out the credit side of equipment to another account called accumulated depreciation, where we have the amount that we believe it's gone down by, it's depreciated by, there's the 1,000, the book value of the equipment then, 60,000 minus 1,000, or 59,000. So this is our first contra account, contra asset in this case, because it's contra to the norm. How do contra accounts happen? Because we basically split this account in some way, and that created this account, which is dependent on this account, meaning this account, accumulated depreciation, cannot survive without equipment. It's dependent on the equipment. Okay, and then the other side, of course, being the expense going up, representing the amount that we have consumed of the cost to, in this time period, we've consumed it in accordance with the matching principle. That brings net income down, net income calculated as revenue minus expenses. For more accounting information and accounting courses, visit our website at accountinginstruction.info.